Too much of bad news to too much of good news.
Within 40 days.
Yeah, within 40 days.
Yeah, I think, things have turned quite a bit, right, on the positive side. I mean, just about a month back also, there was global challenges. Okay, we had oil at higher levels. The crisis in the NBFC sector, right, which was really bad and trying to pull down the market lower. I think all those things have clearly eased off and for the better. And that clearly caps the downside for the market, right? I mean, upside is still probably some time away.
Really. Why is that?
No, I think in terms of growth itself, okay, what we were looking at, some slowdown pockets, especially after this festive season, we've seen in pockets the growth hasn't been as expected. Some downgrade to earnings we have seen for this fiscal year. In fact, at the beginning of the year, things were looking very good of this fiscal year. But after this quarter, there has been slight cut down in terms of earnings growth estimates for this year, and then we have election. So I think outlook remains positive after this. I think bias remains up, but the big move in the market I think will take some more time. I think liquidity situation, while it has eased off, it's still fairly tight in the market. The inflows are strong. So I think the good news is that the sentiment towards India and the emerging markets, okay, as earlier colleague mentioned, so that has also turned a bit positive, which was a big drag for India. I mean, this year, all throughout the year, we have seen huge outflow from emerging markets. I think there is a view which is coming up that emerging markets could do better, okay, because of the huge underperformance, and also the dollar strength, which was really driving, weighing down on emerging markets. I think that should not be as strong and probably weaken a bit going forward. So I think macro situation clearly has eased off for the better, and that makes us more positive from a slightly medium to long term perspective.
So considering a large chunk of the uncertainties are over, Mahesh, do you think is it time yet to take those tactical calls on your portfolio, time to maybe allocate more to small caps because they haven't caught on as well as the benchmark indexes, or still play it safe, still stick by with large caps?
So, I mean, it's a good question. So, small caps and mid cap, if you would observed in the last couple of months, they have kind of steadied out. A couple of the stocks have bounced back pretty smartly, though it's not across the board, right? I mean, not all the stocks. There are still stocks which are languishing down, and clearly market is much more discerning in terms of small and mid cap space. Only the better names or companies with, less corporate governance issues, clear earnings visibility are doing well. But yeah, I think for the next 3 to 6 months, probably the market might still not, I mean, the small and mid caps might still not really do all that great, because elections and some of these things would still weigh down before one can get a very clear view that the markets are going to do better in terms of the outlook, also in terms of economy. So, but clearly, I think, yeah, this is a time to really start looking at some of these stocks. Valuations have corrected significantly year till date, if you look at it after the fall, and also because the earnings growth has picked up in some of the small and mid cap names in the last couple of quarters. So yeah, so we are not averse to small and mid cap names at this point in time. Look at selectively adding to the portfolio, and hoping that over the once the dust settles down, we have a clarity in terms of how the election outcome is, and also clarity in terms of the overall macro growth. I think they should do better.
You're saying NBFCs will tide over short-term woes. You're looking for value, especially in the high-quality names, because they corrected too in the mayhem.
Yeah, so NBFC challenges in terms of liquidity and rollovers, which was a big problem a month back, that has eased off, though the market is still tight. It's not like funding is available easily. The cost of borrowing has definitely gone up for the NBFCs, anywhere between 100 to 125 basis point, and that will impact some amount of margin pressure. You will see not in this quarter, so because a lot of the NBFCs would have passed on that increase initially, but it will start affecting going forward, and some moderation in growth in overall lending. So if you factor in these two factors and then look at the NBFCs, I think, yeah, there are a few names, stronger companies in the NBFC sector which have fairly decent in terms of the asset quality. We don't see any challenges over there, and also in terms of strong parentage, okay, where so that should not really have a challenge in terms of raising funds, I think they should do well. And the correction has happened. If you look at the banking, I mean, NBFCs have corrected quite a bit. Some of the banks, corporate banks, okay, which also have a kind of a higher risk, they have moved up. So I think the risk reward in select NBFCs for a long-term investors is looking good, because I think the NBFC model will remain here, right? I mean, there have been some challenges, question marks been put, but I think that they'll complement the banking system.
And the word I used to be heard on Dalal Street was you can only predict two things in life: taxes and growth in HFCs. The low-cost housing opportunity is so great that HFCs will never slow down.
Right.
But some of these stocks are down 10, 20, 30, 40, even 50%. Indiabull Housing Finance, I'm just using that as an example, has gone down from 1500 to 600. That's a fall of what? More than 50%?
Right.
Repro Home, again. The point I'm saying is that why? Why are HFCs getting smoked if the growth is so strong?
Yeah. So HFCs in particular, and they still continue to remain depressed. I mean, we've seen other NBFCs, especially which are there in the vehicle finance side or other SME funding, they have bounced back. But on the housing finance side, there are two parts to it, right? One is the retail mortgages, where clearly the cost of borrowings, the margins are always wafer thin over there, right? The HFCs to make the margins clearly in terms of the high yield developer book, which was really and the lab portfolio, which were contributing to the higher yields and for the decent ROAs which were there. So that portion of the book, especially with the developer financing book, is clearly there's some concerns which are coming up over there. I think the tightening of the market itself has squeezed out some of the funds to the building sector, developer side, and that could lead to some amount of stress, is what the market is fearing, and we'll have to wait and see over there. And on the mortgage side, I think the banks have become more aggressive. I think they are the competition is directly with the banks, okay, where the banks still the costs on the liability side remain fairly competitive. So there would be margin pressure over there. So it's a combination of these factors where I think some structurally, I think the overall margin really, I think growth is the other factor, but I think more importantly the margins would come under pressure, and that's why these stocks are got derated quite a bit. And couple of the names, I think the concern on the asset quality also in the developer financing is what is still weighing down on these names.